Hey everyone, it's Anthony Venuto with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode. On this episode, we're going to be talking about interest rates on the move, what is happening, and why are interest rates going up. You don't want to miss it, stay tuned. Mortgage interest rates in Canada are on the rise, and we have seen a significant move in fixed rate mortgages over the past few weeks. And there are different reasons to why that is the case. And in this episode, we're going to try our best to cover some of those items and see exactly why interest rates are on the rise and what does that mean for interest rates moving forward. We'll touch upon a little bit about the Bank of Canada, as well as go over some of the current interest rates for the week ending of October 14th. Now, obviously, it is important to understand how bonds work, as they are the key indicator or the tool used by banks to price generally their fixed mortgages. Now, when a bond is purchased, let's say, for example, I purchase a bond for $100, and at maturity, when it comes up to that maturity date, I get a 1% yield. That technically means at the end of that contract, I get $101 back. My yield is 1%. But let's say I want to unload that bond early. And in order for me to do that, I have to sell it for less than the bond face value of $100. I sell it for $95. The person that gets to purchase that bond actually will yield the full $101, and that yield is over 6%. So they get to profit from that. So simply put, if you have bond prices that are lower, yields are generally higher. And if yields are higher, that means mortgage rates are definitely going to be elevated. Now, obviously, this is a very simplified version or a very oversimplification, but it's important to understand what is happening in the market, as that is a key indicator, right? So if you're looking at bonds, and now we're going to take a look at what has happened over the last few weeks in the UK, and then what that translated to here in Canada and the US, it might give you a clearer picture. So just a few weeks ago in the UK, we had a issue with the pension funds and the Bank of England. So basically, the Bank of England and these pension funds were at a crossroads. It was very uncertain that they were going to be able to come out of this. So the Central Bank of England decided to reinstitute temporarily quantitative easing. That is probably a term that you may have heard over the past few years. And basically, the Bank of England had purchased all these bonds back from these investors and the market, basically trying to push that bond price back down. And in so doing, that had created some turbulence in that market. Now, during this whole time, as things are starting to get worked out, there has been an end date to quantitative easing in UK. Now, obviously, remember, in US and in Canada, we are under quantitative tightening, and we'll touch upon that in just a moment. So if you're looking at the UK under quantitative easing, maybe it's temporary. We'll see how far that plays out, as the end game or end date was supposed to be this Friday. But obviously, I think that the central banks will do whatever is necessary to try to keep that system operating and functioning. Now, what happened is if investors are seeing this turmoil, they may be looking to flee to safety in other markets, which may push those bond buyers to look at other markets. Okay, so now let's pretend that these markets basically move over to US and Canada, which is sort of what we've seen happen over the last little while. That has considerably impacted our bond yields. Now, in the US and in Canada, you have to keep in mind we have another concern. Over the past 2 years, like many central banks and many countries, their governments and banks had purchased up all these bonds, corporate bonds, whatever they were. They ended up buying them by the boatloads. And because these central banks have the unlimited resources to buy these bonds at elevated prices, they can basically push this floor on these bonds, keeping interest rates lower for longer and basically creating liquidity. Now, under quantitative tightening, and here in North America, the US Federal Reserve and the Bank of Canada is trying to push these bonds back into the market. And because they don't have, these hedge funds and investors like you and I don't have unlimited resources to buy them, it is having a significant inverse reaction on the pricing, as there's more bonds hitting the market than there are buyers to consume them. So that definitely has an impact on how interest rates are going to be affected. And it could have a long-term impact, because who's going to buy all these bonds when they hit the market? Who's going to intervene, or what's going to happen in the next little while? But there's another element that's important to look at that is something dear to us, because here at InTouch Mortgage Solutions, myself, I worked in the bank for many, many years. And when clients are speaking to us about interest rates, generally around this time of year, what happens is the banks approach their fiscal year end. And when they approach their fiscal year end, there's a lot of different things that the banks may look at. Will they look at profitability? Are they looking at their amount of revenue? They're looking at the amount of money that they have to lend out. And basically, do they want to be as competitive, or are they going to start being more competitive in the new year? So there are different components and facets when we look at the bank themselves. And the reason behind that is because what happened with the bond market over the past few weeks and what is happening now, we did see some peaks and valleys, but those actual discounts, when we saw the interest rates go up, they moved. But then slowly thereafter, when the UK started buying back all these bonds, the interest rates, the bonds went sort of back down to normal, but the banks did not necessarily translate those discounts into fixed rate mortgages. They ended up keeping them sort of around the same amount. Now that could be because the banks may see that interest rates are going to move further, or it could be what I touched upon earlier, that the banks are approaching their year end and they're not as eager to lend or hit that ceiling for the money that they want to lend out. So it could be a couple of different things happening right now, and it's very difficult to put my finger on the pulse on exactly what it is. But I could tell you it's probably a good mixture of at least all those three. And it's important for consumers and Canadians to understand that if you're approaching renewal or you have a mortgage that's coming up, and if interest rates are going to be on the move, it is very important to look at those items sooner than later, like we touched upon last week. Now, obviously, this is all on the fact that the Bank of Canada will be meeting on October 26th in order to be discussing policy rates moving forward. And it is to the market's anticipation, the market is pricing in at least a 50 to 75 basis point increase by the end of this year. So currently the Bank of Canada policy rate, which had moved all the way from 0.25% in March, all the way up now to 3.25%, should be surpassing 4% by the end of the year. And that is some big news for many Canadians who hold a variable or adjustable mortgage. And obviously that will all be in due time. We'll hear exactly what happens as we await the inflationary numbers for Canada's CPI. Now, as promised, I want to go through quickly some of the current interest rates right now, as they have moved significantly. So just a few weeks ago, we saw 5-year fixed insured mortgages at around 4.49%. And over the last week or two, when that UK issue happened with the bond market, it shot up to around 4.79%. Currently, right now, we're sitting at 504 to 514 for a 5-year insured mortgage. And remember, those are generally the cheapest types of mortgages that you're going to find in the marketplace. Insurable side, everything has sort of felt that pressure, and we're looking at 514 to 534 for an insurable mortgage. That's a purchase or potentially a switch transfer, as long as there's 20% more or equity in the home. And then you have your conventional mortgages, which are your 30-year purchase and refis, anywhere from 5.59 to 5.79%. Huge move, as we've seen those rates significantly jump over the last few weeks. And as we touched upon, variable rate mortgages will be on the rise. These are effective as of the week of October 14th. You're looking at 4.45 to 4.65%. Now, just a key caveat to enter, a lot of times clients will have a question about how the variable works and how, if you get a pre-approval, if the lender will lock in that rate, what they're actually getting. So you can't lock in the policy rate, and obviously you can't lock in a prime rate, as those are very fluid. What you are locking in when getting in a mortgage, a variable, is that offset or that discount. So for example, if you're taking on a 5-year insurable mortgage, let's say the discount is prime minus 1%, prime being 5.45 minus 1, you're at 4.45%. It doesn't matter if the policy rate or the lending rate for the prime banks basically go up. So if prime lending goes up to, let's say, 6.45%, you are always minus 1. At that case would be back at 5.45%. And insurable mortgages have definitely felt that pressure. And one big segment that we're going to introduce is the fixed 1 to 3 year, as that is a big segment for Canadians who are not sure whether to go fixed or variable. And obviously they are expensive at the current moment, and they're starting anywhere from 5.29% to 5.99%. We saw some of those even well below 5% just a few weeks ago, but that has now shifted. And obviously our B banks, they are the most expensive, obviously due to circumstance. And if you're looking to get into the B space, you can see rates starting at 6.5% plus, depending on the type of credit and product you're looking for. And it's very, very important to look at all the rates and what you particularly qualify for. Remember, don't get blinded. When you're looking online, you're going to see the lowest rate, but chances are you have to look at what that rate implies. Is it a purchase? Is it a refinance? Is it a switch? So you have to understand those elements. It's very, very important. So once again, if you like the content that we're producing here at Finance Fridays and you like In Touch Mortgage Solutions, don't forget to hit the like, share, subscribe button. Don't forget to hit that notification bell so you can get posted every time we're going to talk about rates and the Bank of Canada and any changes. Next week, we plan on doing a video talking a little bit more about credit and what is happening in the current marketplace when it comes to lending guidelines. So you don't want to miss that. So we'll leave the video here, wishing everyone a great Friday and an even better weekend ahead. Thank you again for watching. We'll see you next week.